according to Galaxy Research, crypto collateralized lending hitting a record high at the end of Q3, and it means more borrowers are using crypto as collateral in order to secure loans. The overall increase was 38.5%, or about $20.5 billion to $73.6 billion. The October 10th, yes, an infamous day in recent crypto history, the mass liquidation event occurred just days later at the beginning of Q4. As a result, falling collateral values forced automated liquidations on lending platforms, and it prompted sales in order to cover loans. Zack Pokorny joins me now here at the New York Stock Exchange. He joins us from Galaxy Digital's Galaxy Research team. Thanks a lot for being here. Great to have you. Can you take us through record crypto leverage? What has been going on?
Yeah, Q3 was an explosive month or an explosive quarter for crypto collateralized lending. You kind of covered it well. Up 50% in DeFi. This was largely fueled by new synthetic assets like Pendle PTs and carry trade arbitrage strategies. This is a bit different than what we've seen in the past, where we have sort of volatile assets like Bitcoin, ETH, go down the line, being used as collateral to borrow stablecoins. We're actually starting to see more sustainable collateral types with these bond-like assets just kind of being used to loop yield trades, kind of similar to carry trades, but just purely DeFi based. But yeah, CeFi also saw a pretty good quarter. It's up around like 25 billion in outstanding loads based on what we are able to measure. This stuff is a little bit harder to get insight into because these companies are obviously closed source, not open source like DeFi applications. But we do our best to kind of cover and see what's going on there. But yeah, overall it was a huge quarter for crypto collateralized lending.
Is it fair to say that the very leverage that might be somewhat responsible for the downturn here in the last few weeks also kind of is what pushed something like Bitcoin to the all-time high of 126 back on October 6th? So it kind of helps you on the way up, but it very much hurts you if you're in sell-off mode.
Yeah, certainly. I mean, 1010 certainly had an impact on the market. But I think there's a distinction between the crypto collateralized lending that you see through lending apps like Aave versus the sort of ADL Armageddon mass liquidations that we saw in futures markets. These are two very distinct things. So like from the perspective of like perps and futures, like yeah, there was a pretty big liquidation event, but we didn't see the same in crypto collateralized lending. Loans came down, but the amount of liquidations were far less and nowhere near record high.
What does any of this mean for centralized finance crypto lenders themselves? In what way do we see their overall activity increase all around this dramatic price action, up and then down?
Yeah, I mean, the CeFi lenders are doing a much better job of being transparent and just having better more robust practices around collateralization ratios and stuff like that. Last cycle, we saw a lot of uncollateralized lending. We kind of saw how that went, and the report kind of covers it. Went up and then almost down to zero effectively. So now we're starting to see a lot more like over-collateralized lending, less uncollateralized. And obviously the assets behind these loans have matured, like Bitcoin, much lower volatility than where it was in the past. And just focusing on better practices and being more transparent.
Talk to me a little bit about DeFi lending. What does the activity look like here? And in what ways would you say it's most different from centralized finance lending?
Yeah, I mean, I think the primary difference that I'm seeing at least is in the collateral types. CeFi lenders have a big focus on Bitcoin specifically, but also ETH and some of the other majors, whereas through these on-chain channels, we're starting to see more synthetic assets pop up, like these Pendle-type tokens, these yield-bearing stable assets that are being used to create these DeFi-native carry trades, is really the primary difference. Collateralized lending or over-collateralized lending is really common practice, specifically in DeFi because it mostly has to be, and then the CeFi lenders are kind of following suit. But yeah, the big difference here is in the collateral types and how nimble the on-chain apps can be versus these off-chain CeFi lenders.
So take me back to the liquidation event, October 10th. It's like a little moment in recent infamy for this whole conversation, because I mean it has shaped every conversation we've had in the broader crypto space since then. What did we see happen to crypto collateralized loans specifically on that day? And was that day a surprise from where you're situated, or had you expected something like that at some point to happen?
I mean, yeah, when we kind of looked at what was happening, it was kind of like a mismatch of incentives and then some poor risk management choices. But yeah, when we're incentivizing activity through like airdrop programs and like the perps meta was a big thing for users, like piling into these leveraged applications, like stuff like that can happen. So while the magnitude of the event was massive, it's not all too surprising, just given kind of where users were piled up and where the incentive for them to sort of like trade and take out leverage.
Before I let you go, talk to me a little bit about what you're tracking for the rise of event contracts, the broader prediction market space this year, and where you think the industry stands as we head into 2026. Been impossible to ignore.
Yeah, no, prediction markets are definitely the most exciting on-chain phenomenon, in my opinion. I think we're going to see two key evolutions here. It's going to be at the asset level, and then these markets as sort of hedging instruments and decision-making mechanisms. On the asset level, I mean, if you use like Polymarket or some of these other prediction markets to the front end, you wouldn't actually know per se that the yes/no tokens or the probability tokens that you trade are actually assets. So from the asset perspective, I see a world where these things leave the prediction market platforms and kind of proliferate across DeFi. So using prediction market positions as like say collateral in a loan or as collateral to go trade on leverage. So yeah, the proliferation of these assets across DeFi, and then as hedging instruments, I kind of see them evolving into what we're calling impact markets in the industry, which is not trading off of probabilistic odds of these markets, like will the Fed cut 25 bips, like 75% chance yes, 25% chance no. It's like, okay, if the Fed cuts 25 bips, what will the price of Bitcoin be? So the market's kind of moving away from these synthetic yes/no tokens to actually pricing individual assets based off of events and turning into hedging instruments that way. So I think, yeah, those are the two major focus points.
I got about 30 seconds, less than a minute or so with you. Anything else on your radar that you're paying attention to, you think the rest of us should pay a little bit more attention to, Zach, as we head into the new year?
Yeah, I mean, crypto lending, I think, is still going to be a massive topic of discussion, and it's going to evolve massively with the introduction of vaults and just the closing gap between the institutional off-chain presence into kind of the on-chain economy. So the impacts on interest rates and the different strategies that pop up through blockchain-based vaults, I think, are going to be a big topic to follow.
Zack Pokorny from Galaxy Digital's Galaxy Research Team, thanks a lot for taking the time to join me. It's great to have you here. All the best for the New Year's holiday.
Likewise, thank you very much.
Doing anything fun?
Nope, just hanging out at home this year.
Okay, so that's probably the most fun thing you could possibly do. I'm just, it's the type of night you might think like, I want to get out there, fancy dinner reservations. Just it's kind of a chaotic night, at least around here in New York City. So all the best for the holiday. Thanks for being here.
Likewise, thank you very much.
We'll talk to you after the New Year.